Hey there, Singaporean investors. If you're keenly interested in Singapore Exchange, SGX, and you're wondering whether to buy more of the stock, or perhaps even consider selling it right now, you are absolutely in the right place. I'm Iggy from the Investing Iguana, and in this video, I will provide you with a candid, balanced breakdown, focusing on 3 compelling good points that make this stock attractive, and then, just as crucially, 3 significant bad points or red flags you absolutely need to be aware of. And make sure to stick with me all the way to the end, because in the final segment, I will give you my personal investment advice on whether to buy, sell, or hold this particular stock for your portfolio. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers. We've crossed the 1 million mark for reads, and with over 900 videos and 500,000 watch hours, content is literally all I do. I also focus on regional and global economic trends, giving you that broader context. If you're serious about uncovering the hidden gems and potential pitfalls in the Singapore market, you'll want to hear this. Let's kick things off with the positives. For Singapore Exchange, one of the most compelling strengths we've identified is its dominant position in Asia's derivatives market. Think about it. In Singapore, stability often translates to strong long-term returns, especially for CPF investments. SGX holds a commanding share of the Asian derivatives market, almost acting as a fortress that protects it from new entrants. We've seen this play out in its explosive growth, which is evident from its latest financials, showing a record 17% surge in derivatives volume to 315.8 million contracts in FY 2025, with daily average volume hitting 1.3 million contracts. This dominant position provides a strong foundation, but is it enough to guarantee future success? Moving on to our second good point, SGX's unprecedented government backing through the $5 billion support program. For many Singaporean investors, government support is key to long-term stability, and this company has received the largest intervention in Singapore's capital markets history. The Monetary Authority of Singapore announced this $5 billion equity market development program in February 2025, specifically targeting small and mid-cap companies that have been neglected. This isn't just about income. It reflects the government's commitment to making SGX a vibrant financial hub. Consider how this massive support could revitalize the entire ecosystem, especially if you're looking at long-term growth potential. It's certainly a comforting thought in today's volatile market, isn't it? And finally, the third positive aspect worth highlighting for Singapore Exchange is its record-breaking financial performance and defensive characteristics. It's not just about what a company's doing now, but what it's achieving right now. SGX delivered its highest half-year revenue and net profit since listing in 1H FY 2025, with net revenue up 15.6% to $646.4 million. And adjusted net profit increasing 27.3% to $320.1 million. These results show SGX isn't just surviving, it's thriving, with securities' daily average value reaching a 4-year high of $1.3 billion, potentially leading to significant earnings expansion as the derivatives boom continues. Are these strong results truly sustainable, or are they just a temporary boost? We'll dig deeper into that. Now let's turn our attention to the flip side. The 3 critical red flags you need to consider before making any investment decisions on Singapore Exchange. The first significant concern is the structural decline in its equity market business. While derivatives are booming, the core equity business is struggling badly. Their latest market data reveals a shocking reality. SGX attracted just 4 IPOs in 2024, raising only $31.4 million, compared to Bursa Malaysia's 55 IPOs raising just $1.5 billion. This could impact its ability to attract quality companies and maintain its status as a regional financial hub, especially when you see the number of listed companies plunging 20% in just 5 years, from 782 to 622 by January 2025, a key concern for investors who want diversified exposure to Singapore's economy. How much market share can SGX lose before it becomes irrelevant in equity markets? Our second red flag is SGX's dangerous dependence on treasury income from interest rates. Even profitable companies aren't immune to external factors they can't control. We've recently seen Treasury income become a major profit driver during the rate hiking cycle, but now it's declining as central banks cut rates globally. This income stream is essentially a leveraged bet on interest rates using customer collateral balances. And unlike trading fees that can grow with volumes, Treasury income depends purely on rate levels. SGX cannot influence. It's a classic case of easy money that can disappear quickly. Will SGX be able to replace this income source fast enough when rates stay low for extended periods? For even more granular data, in-depth charts, and a full written breakdown of SGX's financials and strategic outlook, make sure to check out our Substack. The link is right there in the description. Finally, the third major concern for Singapore Exchange is intensifying competition from regional powerhouses with deeper pockets. Diversification isn't just for portfolios, it's vital for maintaining market leadership. Hong Kong exchanges continues to challenge SGX's derivatives franchise, while Indian authorities have systematically worked to repatriate derivatives trading from SGX by restricting data access, directly targeting SGX's profitable Nifty 50 futures business worth millions annually. This competitive pressure is something Singaporean investors, who often seek stability, must seriously consider. What happens if SGX loses its China A50 dominance to Hong Kong? Or if India successfully eliminates SGX's Indian derivatives business? These are the questions that keep seasoned investors up at night. All right, we've weighed the good against the bad for Singapore Exchange. We've looked at its derivatives market dominance, its massive government support program, and its record financial performance. But we've also squarely faced the challenges: the equity market structural decline, treasury income vulnerability, and intensifying regional competition. So, what's my overall assessment for Singapore Exchange? This is a company with strong defensive characteristics and impressive recent performance, but it's currently trading at premium valuations that demand careful consideration. Considering all these factors, my personal rating for Singapore Exchange is a hold. My clear justification for this is that while the derivatives business fundamentals are genuinely strong and government support is unprecedented, the current valuation at 25.8x PE trading near 52-week highs creates too much risk for a strong buy recommendation right now. Similarly, the strong derivatives franchise and government backing prevent a sell rating, as there's still significant long-term value in this financial infrastructure play. For Singaporean investors, my strategic advice is this. If you already own SGX shares, holding onto your position makes sense if you're invested for the long haul and are comfortable with the identified risks, especially given the government's clear commitment to supporting the exchange. However, for those looking to initiate a new position or add to their holdings, I would advise patience. Wait for clearer signs of valuation, normalization, or a pullback from current highs before committing new capital. This stock, while robust, requires careful timing in the current market environment. Is it a good fit for your CPF portfolio? Potentially, but only if you have a very long investment horizon and can stomach the potential short-term volatility from treasury income fluctuations and competitive pressures. So, we've broken down Singapore Exchange piece by piece, looking at its strengths and weaknesses, and I've given you my personal verdict and strategy advice. If you found this level of in-depth, actionable analysis truly valuable, please give this video a like, share it with fellow investors, and subscribe to the Investing Iguana channel so you don't miss our future deep dives. And for those who want to be truly ahead, our premium members gain exclusive early access to all our videos, often a full week before anyone else sees them. This means you get Iggy's detailed analyses and urgent insights on major market moves directly to your inbox, giving you a significant head start. It's just $1 a month, less than a cup of coffee. Think of it as your consistent, daily dose of financial fuel for smarter decisions, delivered before the masses. Ready to join the inner circle and get that early edge? Just click the link in the description below to become a premium member today. Before you go, if you're interested in another deep dive that explores sector trends impacting SGX, check out my video, The Future of Singapore's REITs, Opportunities and Risks in 2025. You'll find the link in the description.